American Express, from Pony Express to financial empire. In the sweltering heat of a Buffalo, New York warehouse in 1850, three ambitious entrepreneurs made a handshake deal that would eventually create one of the world's most powerful financial empires. Henry Wells, William Fargo, and John Butterfield pooled their express delivery companies to form the American Express Company on March 18, 1850, with initial capital of just $150,000. What began as a freight forwarding service connecting New York to the expanding American frontier would transform into a global financial colossus worth over $200 billion today. These men understood something fundamental about human nature and commerce that most of their contemporaries missed entirely. People needed more than just transportation of goods. They needed trust, security, and reliability in an uncertain world. Wells brought his experience from Wells and Company. Fargo contributed his expertise from Livingston, Fargo and Company, while Butterfield added his extensive stagecoach operations. Their combined vision wasn't just about moving packages faster or cheaper than competitors. It was about creating an unbreakable bond of trust between the company and its customers. The timing was perfect. America was expanding westward at breakneck speed. Gold had been discovered in California, and traditional banking systems couldn't keep pace with the nation's explosive growth. From that modest Buffalo warehouse, American Express would eventually process over $1.3 trillion in annual transactions, but the journey from freight forwarder to financial titan required navigation through economic panics, world wars, technological revolutions, and countless strategic pivots that would have destroyed lesser companies. The early years of American Express were defined by relentless expansion and an obsessive focus on reliability that bordered on fanaticism. By 1851, just 1 year after founding, the company had established routes covering most of the northeastern United States, with Wells personally guaranteeing that every package would reach its destination or the company would make full restitution. The express business model was brilliantly simple yet revolutionary for its time. American Express would accept packages, money, and valuables from customers, transport them via stagecoach, railroad, or horseback, and deliver them safely to recipients hundreds or thousands of miles away. The company charged premium prices but delivered premium service, often completing deliveries that the U.S. Postal Service couldn't or wouldn't handle. When Wells and Fargo left in 1852 to establish Wells Fargo and focus on California's booming gold rush, James Congdell Fargo took control and proved to be an even more visionary leader. Under his guidance, American Express pioneered the concept of end-to-end package tracking, maintained detailed records of every shipment, and established a network of local agents who became pillars of their communities. By 1860, the company operated over 890 offices across the United States, employed thousands of agents, and had become synonymous with reliable delivery service. The company's green uniform and distinctive logo became symbols of trust and efficiency, recognizable from Boston to San Francisco. During the Civil War, American Express demonstrated its patriotic commitment by establishing special routes to deliver mail and packages to Union soldiers, often at great personal risk to company employees who traversed dangerous Confederate territory. The transition from express delivery to financial services began almost by accident, but reflected the company's genius for recognizing and seizing unexpected opportunities. During the 1880s, James Fargo took a European vacation that would change the trajectory of American Express forever. He discovered that his letters of credit, the primary method for international travelers to access funds, were often rejected by European merchants and banks who didn't recognize his credentials or simply refused to deal with the complicated paperwork. Frustrated by this experience, Fargo returned to New York determined to solve the problem not just for himself but for all American travelers. He assigned Marcellus Fleming Berry, the company's general manager, to develop a better solution for international payments. Berry's innovation was elegant in its simplicity: the traveler's check, which launched on August 1, 1891. These checks were prepaid, carried distinctive security features, required 2 signatures for validation, and were backed by the full faith and credit of American Express. The company guaranteed to honor them anywhere in the world, creating an instant global currency that was both secure and convenient. The first traveler's checks came in denominations of $10, $20, $50, and $100, and within a decade, American Express had sold over $23 million worth of these revolutionary financial instruments. The traveler's check business exploded because it solved multiple problems simultaneously. It eliminated the risk of carrying large amounts of cash, provided recourse if stolen or lost, and gave travelers access to funds anywhere. American Express maintained relationships with local banks and merchants. The early 20th century marked American Express's transformation into a truly global financial powerhouse as the company aggressively expanded its services and geographic reach. By 1914, American Express operated 5,000 offices worldwide, had established banking relationships on every continent, and processed millions of dollars in international transactions annually. The outbreak of World War I created both crisis and opportunity for American Express, as European travel plummeted but demand for international money transfers and financial services skyrocketed. The company positioned itself as the primary conduit for American businesses investing in European reconstruction, American families sending money to relatives abroad, and foreign companies seeking to establish operations in the United States. Ralph Reed, who became president in 1944, recognized that American Express needed to evolve beyond travelers' checks to remain competitive in the rapidly changing post-war economy. Reed's strategic vision centered on three key principles: diversification of financial services, expansion into emerging markets, and leveraging the company's reputation for trust and reliability to enter new business sectors. During the 1950s, American Express launched its first credit card services, entered the travel agency business through strategic acquisitions, and established the American Express Travel-Related Services division that would become its most profitable unit. The company's expansion into travel services was particularly brilliant because it created a complete ecosystem where American Express could serve customers from the moment they planned a trip through their safe return home. Hotels, restaurants, airlines, and tourist attractions around the world began accepting American Express travelers' checks and credit cards, creating a self-reinforcing network effect that made the company's services increasingly valuable to consumers and merchants alike. The launch of the American Express Charge Card in 1958 represented one of the most successful product innovations in financial services history and established the template for modern premium payment systems. Unlike traditional credit cards that allowed customers to carry balances and pay interest, the American Express card required full payment each month, which appealed to affluent customers who valued convenience over credit and wanted to avoid the stigma associated with consumer debt. The company's marketing genius lay in positioning the card not just as a payment method, but as a symbol of success, sophistication, and membership in an exclusive club. The famous tagline, "Don't leave home without it," became one of the most recognizable advertising slogans in history because it perfectly captured the aspirational lifestyle that American Express represented. Within 5 years of launch, over 1 million people carried American Express cards, and the company had established acceptance at over 85,000 merchants worldwide. The card's distinctive Centurion logo, premium customer service, and exclusive benefits like access to airport lounges, concierge services, and special events created powerful emotional bonds between customers and the brand. American Express understood that wealthy customers weren't primarily motivated by low fees or interest rates. They wanted prestige, convenience, and recognition of their status. The company charged higher fees to merchants than competitors like Visa and MasterCard, but justified these costs by delivering more affluent customers who spent larger amounts and were less price-sensitive. This strategy created a virtuous cycle where premium merchants accepted American Express to attract wealthy customers, while wealthy customers used American Express cards because they were accepted at premium establishments. The 1970s and 1980s witnessed American Express's bold diversification into investment banking, insurance, and retail brokerage through a series of high-profile acquisitions that transformed the company into a comprehensive financial services conglomerate. James Robinson III, who became CEO in 1977, orchestrated this expansion with the vision of creating a financial supermarket where American Express could serve all of a customer's financial needs under one roof. The acquisition of Shearson Loeb Rhodes in 1981 for $930 million instantly made American Express a major player in investment banking and securities trading. This was followed by the purchase of Lehman Brothers for $360 million in 1984, creating Shearson Lehman American Express, one of Wall Street's most powerful firms. The company also acquired Fireman's Fund Insurance, IDS Financial Services, and dozens of smaller firms to build capabilities in property insurance, life insurance, mutual funds, and retail banking. At its peak in the mid-1980s, American Express employed over 100,000 people worldwide, managed more than $200 billion in assets, and generated revenues exceeding $15 billion annually. The diversification strategy initially appeared brilliant as it reduced the company's dependence on the cyclical travel industry and provided multiple revenue streams from different customer segments. However, the complexity of managing such diverse businesses soon created significant challenges, as the skills required to run a credit card company were vastly different from those needed to compete in investment banking or insurance. Cultural clashes emerged between the traditional American Express emphasis on customer service and the aggressive, transaction-focused culture of Wall Street firms. More critically, the conglomerate structure prevented American Express from achieving market leadership in any single business line outside of travelers' checks and charge cards. The late 1980s brought a series of crises that nearly destroyed American Express and forced a fundamental reevaluation of the company's strategy and core values. The October 1987 stock market crash devastated the company's investment banking and brokerage operations, while a massive salad oil scandal at the American Express subsidiary resulted in over $400 million in losses and severely damaged the company's reputation for integrity. Simultaneously, Visa and MasterCard were gaining market share by offering credit cards through thousands of banks with more flexible terms and lower merchant fees, while new competitors like Discover Card were challenging American Express's premium positioning with innovative rewards programs. The company's stock price plummeted from over $60 per share to below $25 as investors lost confidence in management's ability to navigate the multiple challenges facing the firm. James Robinson's leadership came under intense scrutiny from the board of directors, major shareholders, and financial media, who questioned whether American Express had strayed too far from its core competencies in pursuit of growth and diversification. The crisis deepened when several major merchants, including Costco, announced they would no longer accept American Express cards due to high interchange fees, threatening the fundamental network effects that made the card valuable to other merchants and cardholders. By 1993, it became clear that dramatic action was necessary to save the company, leading to Robinson's departure and the appointment of Harvey Golub as CEO with a mandate to restructure American Express and return it to profitability. Harvey Golub's tenure as CEO from 1993 to 2001 marked one of the most successful corporate turnarounds in business history, as he systematically refocused American Express on its core strengths while rebuilding its competitive position in the payments industry. Golub immediately began divesting non-core assets, selling Shearson to Primerica, spinning off Lehman Brothers as an independent company, and disposing of insurance subsidiaries to raise cash and reduce complexity. His strategy centered on the recognition that American Express's greatest assets were its brand reputation, customer relationships, and global acceptance network, not its ability to compete with specialized financial services firms in their core markets. Golub invested heavily in technology infrastructure, launching the company's first online services in 1996 and developing sophisticated data analytics capabilities that allowed American Express to better understand customer spending patterns and preferences. The company introduced new card products, including the Blue Card with its embedded chip technology, co-branded cards with airlines and retailers, and small business credit cards that opened entirely new customer segments. Most importantly, Golub refocused the organization on customer service excellence, implementing rigorous training programs for customer service representatives and establishing service-level guarantees that exceeded industry standards. The turnaround strategy also included aggressive cost reduction, eliminating over 15,000 jobs while simultaneously investing in high-growth areas like merchant services and international expansion. By 2001, American Express had returned to consistent profitability, achieved record card member spending levels exceeding $250 billion annually, and rebuilt its stock price to over $50 per share. Golub's success demonstrated that focused execution of a clear strategy was more valuable than diversification for diversification's sake. Kenneth Chenault's leadership from 2001 to 2018 represented American Express's evolution into a modern, technology-driven financial services company capable of competing effectively against both traditional banks and emerging fintech startups. Chenault, who became the first African-American CEO of a Dow Jones Industrial Average component company, inherited a stable but mature business that needed to adapt rapidly to changing consumer preferences and technological disruption. His strategic vision emphasized digital transformation, international expansion, and the development of new products and services that leveraged American Express's unique data assets and customer relationships. Under Chenaude's guidance, the company launched mobile payment applications, developed sophisticated fraud detection systems, and created personalized rewards programs that used machine learning to predict customer preferences. The acquisition of Revolution Money in 2009 for $300 million provided critical digital capabilities, while partnerships with technology companies like Apple and Google ensured American Express remained relevant as consumers shifted toward mobile and contactless payments. Chenaude also oversaw significant international expansion, particularly in emerging markets like China, India, and Brazil, where growing middle classes represented enormous opportunities for premium financial services. The company's membership rewards program grew to become one of the most valuable loyalty programs in the world, with over 50 million active participants and partnerships with hundreds of airlines, hotels, and retailers. Perhaps most importantly, Chenaude positioned American Express as a technology company that happened to provide financial services rather than a traditional financial services company that used technology, investing billions of dollars in software development, data analytics, and artificial intelligence capabilities. Today's American Express, under CEO Stephen Squary's leadership since 2018, stands as a testament to the power of consistent execution, customer focus, and strategic adaptation in building lasting business empires. The company processes over $1.3 trillion in annual network volume, serves more than 130 million card members worldwide, and generates annual revenues exceeding $50 billion while maintaining industry-leading customer loyalty metrics. The transformation from Henry Wells Freight Forwarding Company to a global financial technology leader illustrates several crucial principles of empire building that remain relevant across industries and eras. First, successful companies must maintain an obsessive focus on customer trust and service quality, even when facing intense competitive pressure to cut costs or compromise standards. American Express has never wavered from its commitment to customer service excellence, a principle established in those early Buffalo warehouses and reinforced through every subsequent crisis and challenge. Second, true business empires are built by companies that can successfully navigate technological disruption while preserving their core value propositions. American Express has survived and thrived through the transitions from stagecoaches to railroads, from paper checks to plastic cards, and from physical payments to digital transactions. Third, the most enduring companies understand that their greatest assets are often intangible: brand reputation, customer relationships, and network effects that create barriers to competition and enable premium pricing. Today's American Express continues to charge higher merchant fees than competitors because it delivers more valuable customers, demonstrating that superior value creation enables superior value capture. Finally, the American Express story proves that companies can successfully reinvent themselves multiple times while staying true to fundamental principles. The company has been an express delivery service, a traveler's check issuer, a charge card provider, a diversified financial services conglomerate, and now a technology-driven payments network. But through every incarnation, it has remained committed to trust, security, and premium service. From three entrepreneurs' handshake in 1850 to a $200 billion market capitalization in 2024, American Express exemplifies how vision, execution, and adaptation can build empires that endure across centuries.